Good day, and welcome back to the 50-Day Property Challenge brought to you by the EDPF Property Academy and Private Property. Today is day 14, and we've asked our challengers to continue watching the videos we've created on property investment fundamentals whilst going out in search of their first property in this challenge. Enjoy session 2 as we teach you all about principles of financial freedom and successful property investing.
Hello property enthusiasts, and welcome to the second part of our series on property investment fundamentals. I am Nigel Adriaanse, the CEO and founder of the Enterprise Development Property Fund, and I will be your host for the next few sessions as we deal with this particular topic. Today, we talk about the principles of financial freedom. This part of the series will help you to decide what you're going to do, how you're going to do it, and how you're going to create financial freedom for you and your family. So let's get going. In order for you to create financial freedom for yourself, one of the most important things, one of the key things that you have to do is to set goals. Without goals, you basically will go nowhere. Without goals, you won't know what to direct your energy into. Without goals, you will not be able to strategize and build on this legacy that you are hoping to build in order to create financial freedom. You need to set clear financial goals in order for you to start this property journey. What do I mean by all of this? So, when you set up your goals, you can have many goals in life. You can have a goal to go overseas one day, climb Mount Everest. You can have a goal, like I do, is to swim with the dolphins in Australia. There are wild dolphins there that you can swim with, and that's one of the goals that I have for my life. But in order to create financial freedom, you need to set goals that are financial goals. Goals that will help you to understand how much funds you require in order to become financially free. Now, financial freedom means a lot of things to different people. For some, it will mean that they have enough money which will bring them an income so that they can retire. For others, financial freedom could be that they have enough money that they can travel the world for as long as they wish. For you, financial freedom could mean something completely different. At the end of the day, financial freedom all relates back to that one thing. What are your financial goals? In order to create financial freedom, you have to set those financial goals. The next thing is education. You need to seek out the best education, the best property education for you to start this journey. Do not settle for anything that is subpar. Do not settle for anything that is not going to give you enough education and information to grow your business the way you wish to grow. Going back to the goals, you need to set your goals from an education perspective to say, what do I need to learn in order to become financially free and to be able to raise the amount of capital that I need in order to be financially free, in order to retire, in order to take those trips, in order to have enough money to give my kids when I one day pass away, etc., etc. That education is the key to unlocking your opportunities. Because without the education, you will not understand the industry, you will not understand financial calculations, you will not understand where the best deals are, you will not understand how and where to find those deals, you will not understand how to negotiate with a seller or a real estate agent in order to get the best deals. You will not understand how to know what a good deal actually looks like. So you need to seek out the best education. I obviously would recommend that you come here to our incubator, whether it be in Cape Town or Johannesburg, and hopefully by 2025 we will have incubators in every province in South Africa. And then we're looking to expand internationally and starting obviously in Africa. So we obviously would hope that you come and join us here at the Enterprise Development Property Fund. But if you choose not to, there are plenty of other organizations out there that you can learn about property from. You could read books, you could listen to podcasts, you could watch videos on YouTube and a whole host of other places that you can watch videos. There are plenty of opportunities and ways for you to learn all about property. But the bottom line is that you need to educate yourself in how to start and develop a property portfolio. Without that education, you will almost certainly fail. I'm not saying that everybody that goes into property investment fails because they don't have education. The education will come, whether it be upfront, learning from others and their mistakes, or making your own mistakes and ending up in a situation where you actually have learned by the school of hard knocks, where you have had so many hard knocks and you've lost so much money because you've made so many mistakes. But it's through those mistakes that you have actually been able to educate yourself and learn what not to do. So the next thing that you need to understand in order to create financial freedom is cash flow. What you need is a positive cash flow. That means that you're spending less money than what you've earned. So on the one hand, you've got rental income and potentially some other income as well. If you're still working, you've got your own salary. Then on top of that, you've got your cash flow that comes from your property investments. But at the end of the day, you want to have a positive cash flow. So all the incomes that you've received, minus all the expenses that you have in the business and in your personal life, at the end of the day, you want to have a positive cash flow. That will help you to grow your property portfolio. The next thing that you need to understand is investment. You need to become an investor. In order to create financial freedom, working for a boss for the rest of your life is not going to give you financial freedom. Financial freedom is, like I said, means different things to different people. But in the main, financial freedom means that you do not have to work for that next paycheck. That your income that you are receiving outside of your job is enough to sustain your lifestyle. That is effectively what financial freedom means. Is that you have enough money outside of your job in order to sustain the lifestyle you have or the lifestyle you want. A lot of people, what they have done when they've built a property portfolio, they've kept their jobs. They've continued to work a 9 to 5, earn the salary in order to cover their daily expenses and their monthly expenses, but at the same time investing in property. They've then invested over a period of time to a point where the income, the net income, not the gross income, not all your rentals, but your rentals minus all your expenses and all your bonds, etc., that at the end of the day, their cash flow is enough to actually cover the costs that their salary is currently covering. Then once you get to that point, you have a decision to make. You either stay in your job, continue to earn that income in order to cover your lifestyle expenses, and then continue to grow your portfolio above and beyond what it is at that point. A lot of people will get to that point and say to themselves, you know what, now I have that financial freedom, I can quit my job and I can now go and work full-time as an investor. In that way, you can grow your portfolio much quicker, because effectively what then happens is you are now free for those 8 or 9 or 10 hours that you are working normally on a daily basis to, instead of working this 9 to 5 job, have the time to go out looking for deals. Imagine having 40 or 50 hours extra every single week to be able to go look for deals, structure deals, and grow your portfolio. Imagine how much more quickly and more exponentially your property portfolio can grow when you're doing that versus working 40 or 50 hours a week in a 9 to 5 job. So most people who want to become professional property investors get to that point and they say, now I will make the decision to quit my job and go into this property investment thing full time, because the income that I'm getting from it now is enough to cover my monthly expenses. But you may choose not to do that. You may choose to stay in your job, and you may choose to continue to grow your portfolio part-time. All I'm saying is that you will not be able to grow it as rapidly as you would if you're working in it on a full-time basis. Then the next thing is to reinvest. Once you start growing your portfolio, don't take the money out, because you'll never grow your portfolio that way. Leave the money in the business and reinvest either into that particular property so that you grow the equity in the property. And again, as I said earlier in the previous session, equity is the difference between the value of the property and what you owe in your bond or whatever other debt you have. That equity can quickly grow if you put money back in from the rental income that you achieve. You could, however, decide to take that money and put it into the next property as a deposit. Get a loan then, another bond for the second property, and utilize the income that you're getting from this first property in order to pay the deposit and the legal costs, the transfer duties, all of those costs. Then once you've got that second property, you can then take the equity in both those properties, leverage it, get more funding in order to then purchase your next property. And that's how you grow your property portfolio, by reinvesting the profits that you make, not only from the rental incomes, but also from the sale of any property. So once you've sold the property, you then take the profits that you've made off the sale of that property and then reinvest into the next property. All right. The next thing is assets. Ensure that you invest in the correct asset allocation. Now, here I don't only mean property. So on the one hand, you need to make sure that your investments in the property portfolio is in the correct asset allocation or the correct strategy. So either rent to buy, flipping, or student accommodation, or retail, commercial, whichever strategy you use and the type of property that you choose to invest in, make sure that it is the correct asset allocation within your property portfolio. But then on top of that, also look at other investment opportunities where there's potential for generating good income and good returns. So you may look at the stock exchange, you may look at other private investment opportunities, other businesses. You may want to start a farm. You may want to start making cups and mugs and sell those. You may want to make samosas and generate income that way. So you need to look at different ways to generate income. Then you also always need to have some cash available. Now I'll tell you why these are all important, and that your asset allocation must always be spread over different assets within property, but also outside of property, and to always have cash. The cash part is so that if you run into any kind of difficulty in any of your assets, in any of your investments, that you always have that cash available to tide yourself over until you get back on your feet again. So let's say, for example, COVID, we've had the lockdown. We are sort of coming out of it now. It's the end of 2020. But when we got into this at the beginning of the year, what happened? A lot of people lost their income. A lot of people, especially in the property sector, lost their revenue stream because those people who were renting from them didn't have money because they themselves have lost their income streams. So if you had cash available, you could overcome this this difficult time, by allocating that cash towards your running expenses. At the same time, negotiating with the bank and with government to get grants and loans in order to keep going. But that cash availability was very important to everybody that was struggling in their business or had lost their job, because you now have this cash available that will tide you over for this period. The reason I suggest that you allocate your money over different asset classes is because if the one asset class is not in demand at a particular time, you may not earn enough rental income from that particular asset in order to cover all your expenses. So you need other assets that will bring you income in order to help you when tough times come in this particular asset class. So you must always diversify your investments over a different range of asset classes. Now, the asset classes that you invest in is your decision. You need to decide based on your own risk profile, based on all of the issues that relate to your personal experiences and what you require from an income perspective, and what your risk profile is. You then decide based on that which assets you want to invest in. Personally, I would recommend that you invest in assets that you understand, that you have done due diligence on, that you know the people involved, that you don't go and invest in something where you have no idea of what it is you're investing in. So a lot of people will invest in things like Bitcoin without understanding what this Bitcoin thing is all about. Now, yes, there's a lot of money to be made in Bitcoin, for example, but if you don't understand it and you don't understand the flows and the ebbs and of that particular investment, you are going to lose money. I guarantee you that. But if you understand it, you know when to buy, when to sell, when to hold, when to negotiate a better deal, when the markets are ready, when they are not ready. If you understand those things and you understand that particular asset class, then I would say, yes, go ahead and invest in it. But if you do not understand the asset class, I would say, do your homework first. Learn about it. Educate yourself. Speak to people. Read books. Watch YouTube videos. Do your due diligence before investing in any asset class, whether it be property, the stock exchange, or Bitcoin. Okay. Then, one of the most important things is getting ready for a new reality. This new reality means that you have to commit yourself to tough decisions. Sometimes there'll be tough times. You commit yourself to hard work. You need to be patient. You need to have faith. You need to have passion. And you need to sacrifice. So let's take each of these individually. Tough decisions. Sometimes, and I've experienced this myself, you look at this asset and you go, you know what? This thing just isn't working out. I am just not able to generate enough money to pay my expenses. So then you are faced with a tough decision. Do I hold on to the asset and keep pumping money in myself to keep it afloat? Or do I sell it and try and maximize the profits that I possibly can and then invest in something else? Or even maybe selling it at a loss because you're losing money hand over fist on the asset. You then have to make that tough decision and let go of that asset so that you can move on to something better. And yes, you may have lost some money, like I have many times, but at least you've come to a conclusion, you've made the tough decision, you've cut ties with that asset, you've lost some money, but you are able to now take what you have salvaged and invest in something better. There will be tough times. COVID lockdown is a classic example. But there are many other times when things are tough. You may lose your job, and then you're going to be relying on your portfolio to bring you that income to cover your expenses. During those tough times, you're going to have to tighten your belt. You're going to have to cut some unnecessary expenses. Every single one of you, at some point in your life, have gone through tough times. And if you are too young to have gone through tough times, I promise you that sometime in your life there will be tough times. You need to be ready for those tough times. You need to be sure that, like I said, you've saved enough money, you've got enough cash flow, or cash sitting in the bank, that's going to take you through a period where you're not getting an income. And the tough times are there. Expenses have skyrocketed. Food is expensive. Housing is expensive. When you go and rent a place, today you may pay 10,000, tomorrow you're paying 15,000. And all of a sudden, that extra 5,000 rand that you had in your pocket every month is gone. So tough times will come, and you need to prepare yourself for those tough times. If you want to start a property portfolio, prepare for hard work. You cannot start any business and think that it's going to be an easy ride. Sometimes you strike it lucky and the business just flourishes and you're just making money and you're printing money and whatever. But in most cases, anybody that has started a business will tell you that it is difficult and you have to put in a lot of hours, hard work, in order to make your business a success. Do not fool yourself, and don't let anybody else fool you into thinking that investing in property is easy. It is hard work. Of all the 20 years that I've been in this industry now, I have analyzed literally thousands of deals, but we've only invested in a few. I would say on average of all the deals I've ever analyzed, for every 100 deals analyzed, we've probably only invested of anywhere between 2 and 5 of those 100. But in the meantime, we've put in all the effort, all the work in order to understand that asset, to understand that property, doing full due diligence. Sometimes it costs us money because we have to employ people to come and do the feasibilities, to do the architectural work, to do the town planning work, etc., etc. And it costs us money. So it's not just hard work, it also costs money in order to analyze a deal sometimes. And more often than not, in my case, 95% of the deals we've looked at has not actually been successful. Then you need to be patient. Oh man, does this industry require patience? In order for you to be successful in property, I would recommend that you go the long route, that you invest for the long term, that you invest not only for the rental income and the cash flow on a monthly basis, but also for the capital growth over a 10 to 20 year period. Because that's where the real property value lies, is in the growth of the asset itself. Yes, you're going to get rental income. Yes, you're going to get cash flow. But the real growth is in the asset value, and that's where you make your real money. So I would recommend patience for anybody looking to start a property portfolio. The next thing is faith. You need an inordinate amount of faith. Faith in the fact that you are going to be successful. Faith in your own abilities. Faith in people, because you're going to need to bring people on board in order to help you invest in your portfolio. Faith for me in God, because I believe that God will always supply my needs. He will always give me peace. He will always give me joy, even in the tough times. So faith plays an important part, not just if you're a believer and you believe in a God, but in yourself and in other people and in the fact that what you have started will be successful. You need faith in all areas of your life. Then you need passion. Most people who have been successful in business have had incredible passion for what they do. Without passion, people won't be interested in what you're trying to sell them. Without passion, you won't be able to take those next steps that are required to make your business successful. Without passion, you won't be able to wake up in the morning and go, yes, we're going to go for this deal again. Yes, we're going to push through on this one because it's not working, but we're going to push through. Yes, we're going to make this deal happen. Yes, we're going to raise the capital in order to make this deal a success. Yes, we're going to find the right deals. Yes, we're going to find the right real estate agent. You need to have that passion and that faith combined to make your property portfolio successful. And then there is sacrifice. You are going to have to sacrifice so much in order to make your property business successful. In many cases, you're going to have to sacrifice those luxuries that you normally would spend your extra cash on. In order to be successful in business, you need to keep that extra money that you have every month and put it back into your business again. Because in order to grow your business, you need to constantly be pumping money back in order to expand your capacity, to expand your staffing structure, to expand the office space you require if that's what you have, to expand your actual portfolio, because the more money you pump in, the more money you have to put down as equity, the higher the bonds are that you can get, and more money you can raise from investors. There's going to be times when you have to make a decision between buying a loaf of bread and covering a cost that will save you from losing that investment opportunity. There are some tough decisions you're going to have to make and some major sacrifices you're going to have to make. Be prepared and be ready for that. Okay, so the next stage of discussion is about successful property investing. So Richard Branson, one of his favorite quotes, my favorite quotes that he has, is he says, luck is what happens when preparation meets opportunity. Now, I personally don't believe in luck. I don't believe there is something such as luck. And I agree with Richard Branson when he says, luck is when preparation meets opportunity. So basically what he's saying here is, there are opportunities out there. All over the world, everywhere around us, there are opportunities. In order for you to get lucky, you need to prepare to receive those opportunities and to grab hold of those opportunities. You need to prepare to say and put yourself in line, waiting and looking for those opportunities that agree with the preparation that you have put together. So if you prepare and you say, I'm looking and I've built a strategy where I'm going to become an investor and I'm looking for a block of apartments that I'm going to invest in. Now, I haven't found the block yet, but what I'm going to do is I'm going to look at the strategy, I'm going to look at my structure, register my company, prepare for my taxes, get my trust in place if that's the way you choose to create your system and your structure, get my property management in place, get my asset management in place, my facilities management in place, get my team together, and then go and speak to funders and say, listen guys, this is what I want to do, this is the kind of money I'm looking for, and then start getting guys excited about what it is you want to achieve. Once you've prepared all of that, and those opportunities come, and you then say, right, this is the opportunity for me. I'm going to take what I've prepared and now implement into that opportunity. That is when luck happens to people. When you've prepared, the opportunity comes and the two meet each other. So I really love this quote from Richard Branson, because that is what I believe. I believe that if you prepare well, you set up all your structures, you get your team together, you get your funders, when those opportunities come, then you can actually take hold of them. Imagine you wait until the opportunities come. So I've had many opportunities. Every day I get at least 5 to 10 deals that come across my emails. So now I'm sitting there and I've got these 5 deals that have now come. And I look at them and I say, these are great deals. But I haven't prepared. I don't have a team. I don't have a structure. I don't have funders. I've got a bad credit record, etc., etc. So now this deal comes and I talk to the real estate agent, and it's the perfect deal for me, exactly what I was looking for. And I put in my offer and I say, I'd like to buy this property. But because I haven't prepared and I don't have a deposit and I don't have a team and I don't have funders and the banks don't know who I am, that deal's not going to go through. Because what do I have to offer? I have nothing to offer. So if you prepare and you get everything together and those opportunities come and the two marry each other, that's when you get lucky. All right. So within the concept of successful property investment, there are 3 critical things that you need to get your head around. The first one is the difference between assets and liabilities. Now, in this industry, there are many people who will tell you that a property is not an asset while you're still owing money on it. Then it's a liability. Many people will tell you that a property is not an asset if it's not generating income for you. And there's a whole host of other things that a lot of the guys in the industry will tell you, that when a property can't be an asset or isn't an asset. Now, as somebody that comes from an accounting background, and the term asset, I can explain to you, is something that you own. Now, if you own a property, regardless of whether there's debt on it, regardless of whether there's income from it, that property is an asset. Don't let anybody else tell you anything else. A property is an asset, is an asset, is an asset, regardless of debt or income streams. What is the liability is the bond or the debt that you have on that property. The liability is what you owe, not what you own. So if you own a property, it can't be a liability. It is the debt that is the liability. So get that straight in your mind, because that is very confusing, and a lot of the guys in the industry have confused people with regard to this particular concept. An asset, a property, is an asset. It is not a liability, regardless of what anybody tells you. The liability is the debt, the bond, whatever else you owe on the property. Okay, so get that straight first of all. From an accounting perspective, property is an asset, the bond is the liability. All right, okay. The next thing is understanding what positive cash flow is. Now, positive cash flow is effectively the money that comes into your business minus the money that goes out. Now, there's a big difference between positive cash flow and net income, and we'll go through that in more depth at a little bit later stage. The important thing here is to remember that cash flow is not in net income. Net cash flow isn't net income. Net cash flow is your rental income and any other income that you get. So sometimes you've got electricity income and other municipal costs that you can get. Sometimes you can recover your operating costs. You can maybe charge for cleaning. You can maybe charge for security and a whole host of other things that you can charge for. So that's all your incomes. Then you've got your expenses. You've got your interest on your bond. Now listen very carefully. Your interest on your bond is an expense. The capital repayment is not an expense. That is a cash outflow, but it is not an expense. It is a repayment of the capital which sits in your balance sheet, not in your income statement. You got to be very careful there, because that affects your tax. It affects your cash flow, your net income, and your tax. You cannot deduct the bond capital repayment portion as an expense when you're calculating your tax. Now we'll talk a little bit more about that, but I thought it was important at this juncture for you to understand the difference. So net income is all your income, rental, ops cost, electricity, water, all the income that you get, minus all your expenses. Your interest on your bond only, not your capital. Your electricity, water, all the municipal costs that you pay, your maintenance, your gardening services, all those expenses. And then whatever's left over, that is your net income. That is what you get taxed on. All right? You get taxed on that net income. Now, if you have a company, you can write all those things off. All those expenses you can write off against your income before you get to your tax calculation. And that's the beauty of structuring your property portfolio in a PTY limited company, because you can now write off all of those expenses in order to calculate your net tax burden. Now, how that differs from net cash flow is that with net cash flow, you also take into account the bond capital portion. So, as a classic example, let's say your rental and all other income is 10,000 Rand. Your expenses is, say, 3,000 Rand. Your bond is, say, 5,000 Rand, including your interest and your capital. So your total outflow is 8,000 Rand. Your inflow is 10,000, your outflow is 8,000. So your net cash flow is 2,000. All right? Your gross inflow is 10. Your gross outflow is 8, including your bond. And then your net inflow is 2. 10 minus 8 is 2. Okay. Now if you take the same calculation and you want to work out your net income, you say your gross income is 10, all your other expenses are 3, your bond is 5, but your interest within that calculation is 2. The repayment on your capital is 3, making up the 5. So you got 2 in interest, 3 in capital repayment, total bond repayment is 5. All right? Now this is a very simplistic calculation because you also have other expenses like insurance, there's bank charges and all sorts of other things. Those are all deductible as expenses. But I just want to show this calculation between income, net income and net cash flow with this bond expense here. So now you've got 2,000 and interest, 3,000 and capital repayment. So your net income, as I said, was 10 minus 8 gives you 2. But your net cash flow now, your net cash flow is 10 minus 8 equals 2. But your net income is 10 minus 3, which is your other expenses, minus 2, which is your interest only, leaving you with 5,000 Rand net income, because you don't take the 3,000 Rand capital calculation into your net income calculation, only in your net cash flow calculation. Now we'll talk a little bit more about that at a later stage, but from a perspective of successful property investing, it is an important concept for you to understand. All right. The next concept is BMV, as some put it. Buying below market value. All right? Below market value. Very important concept. Most people in the industry will say to you, you make money when you buy, not when you sell. And how that works is that when you're buying and you're a good negotiator, you can then get the property under market value, which that then means that when you try and sell it at a later stage, there's a profit margin that you can make in order to then extract some value. So if the property is worth $1 million and you negotiate with the seller down to 800,000, You've got a margin of 200,000, but remember, you also have all your legal fees and so on. And because the deal is under $1 million, there's no transfer duty, but there are transfer fees that you have to pay to the attorney. There could also be bond fees because you maybe have to take a bond, and there are other fees that you have to pay. So let's say all those fees are 80,000 Rand. So now you've got 800,000 purchase price, 80,000 in your your fees, which makes the total cost of your property purchase 880,000. But remember, the value is $1 million, which means that you have 120,000 Rand of play if you decide to sell it at a later stage. Then on top of that, you also have obvious growth in the area that you're in. It could be anywhere from 5 or 6% all the way up to 15% on an annual basis, depending on which area you've purchased in. Then if you decide you want to add a little bit of pizzazz to your property, you paint it a little bit, you lay some new tiles, you put in some new basins, maybe you've spent another 30 or 40,000 Rand, maybe even 100,000 Rand. Now you're getting closer to that market value, but because you've enhanced the value of the property, you can now sell it for more than the $1 million Rand. And therefore make even more profit because you've now enhanced the value. All right. So buying below market value gives you that opportunity to make some additional profit when you try and sell the property. It also allows you to, if you're holding the property and you do a buy to let, you then have the opportunity to make a better return when you're renting. Because if you had bought it at $1 million Rand and your net income for the year is 100,000, your profit is only 10%. But if you've negotiated down to 800,000 and your net profit is still 100,000, your margin has increased from 10% to something like 12 or 13%. I don't have a calculator with me now to work out that number, but it will probably be around about 12 or 13% in terms of your profit margin or your yield or your net return. So when you're renting, you're also making a better return if you negotiate up front and you buy below market value. Okay, I think we will leave it there for this second session. We're going to talk next about strategy, area, property, and finance. Those 4 areas are critical when you're investing and analyzing a deal. So until next time, for session 2, this is Nigel, your host and CEO of the Enterprise Development Property Fund, signing off again, and we'll see you next time for session 3.
Thank you for joining us on this, the 14th day of our 50-day property challenge. Watch us again tomorrow as we continue this journey with Matt Al and Jared Ricketts.